If you've been watching the housing market and thinking, there's no way prices can fall, people are still buying, demand is still high. Everyone says real estate only goes up, then what I'm about to show you is going to completely change the way you look at 2025. Because right now, every major indicator, every chart, every economist who isn't paid by a real estate company is quietly warning the same thing. The crash has already started. Not maybe, not in a few years. Now, in the last 90 days alone, we've seen a surge in inventory, the fastest rise since 2008. Mortgage rates are at levels that have pushed millions of buyers permanently out of the market, and home prices, they resitting at a level that simply cannot survive under the weight of the current economy. Everyone remembers 2008. But what most people don't realize is this. The structure of today's housing bubble is way more fragile than what we saw 17 years ago. Back then, the problem was bad loans. Today, the problem is something deeper. Affordability has completely collapsed. People aren't buying homes, not because they don't want to, but because they literally can't afford to, even with a good job. And here's the part nobody is talking about. If home prices fall even 10%, millions of recent buyers will slip into negative equity. If they fall 20 to 30%, which many analysts say is not just possible, but likely, the U.S. economy enters a situation we've never seen before. A housing market where sellers are trapped, buyers are broke, and investors are running for the exit. So the real question isn't, will home prices crash? The real question is, how fast will they fall, and how hard will this hit you? Stay with me, because in the next few minutes, I'm going to walk you through the exact data, the hidden risks, and the one chart that predicts where home prices are heading in 2025. Before we break down the numbers, we need to talk about something more powerful than data: belief. Because right now, the number one reason people think the housing market is safe has nothing to do with math and everything to do with psychology. For the last decade, we've been trained to believe real estate always goes up. It became almost a religion. TikTok gurus told people to buy now before it's too late, agents said. Don't wait, prices will never be this low again. Everyone around you kept repeating, property is the safest investment. And when the government lowered interest rates to near zero, people were convinced buying a home wasn't a choice, it was a race. A race to lock in a deal before you were priced out forever. This created one of the biggest psychological bubbles in history. People didn't just want a home. They feared missing out. They weren't buying because of value. They were buying because of panic. And as prices rose, the belief grew stronger. See, real estate never fails. But here's the truth people hate hearing. A market built on belief can collapse the moment that belief starts to crack. And right now, that crack has already started spreading. Not because of rumors, not because of fear, but because the math no longer works. And the first place this breakdown shows up is mortgage rates. Let's go there. If you want to understand why the housing market is cracking, you only need to understand one number: mortgage rates. Because when mortgage rates doubled, something happened that most people still haven't processed. The average American can no longer afford the average American home. Let me show you how insane this is. In 2020, a $400,000 home with a 2.7% interest rate cost around $1,600 a month. Today, that same house without changing the price at all costs over $3,000 a month. Same home, same salary. Double the payment. So what happens next? Buyers disappear. Not because they don't want a home, but because the bank simply says, you don't qualify anymore. And when buyers disappear, sellers start to panic. Some drop prices quietly. Some wait, hoping rates will fall. Some list their homes for months with zero offers. But here's the part almost no one talks about. The gap between what sellers want and what buyers can afford has become a canyon. We're not talking about a small mismatch. We're talking about a full structural failure in affordability. And affordability is the foundation of the entire housing market. If people can't afford homes, it doesn't matter how low inventory is, how nice the neighborhood looks, how strong the economy seems. Prices must adjust. And right now, mortgage rates aren't just slowing down the market. They're freezing it. They're choking it. They're suffocating it from the inside out. This is stage one of the crash. The pressure point that breaks everything else. And the first major symptom of this pressure: exploding inventory. If stage one was the pressure, stage two is the crack you can actually see. For the first time since 2008, housing inventory across the country is rising faster than anyone expected. Real estate agents aren't saying it out loud on social media, but privately, many of them admit listings are piling up. And this is where the story gets interesting. For years, we were told the demand was so high and the supply was so low that prices couldn't fall. But now, homes are sitting longer. Open houses are empty. Price cuts are quietly increasing week after week. Some sellers are offering closing costs, repairs, incentives, anything to get a buyer. And behind the scenes, you have three groups driving this sudden surge. 1. Airbnb hosts who are bleeding cash. Short-term rental income is down in many cities. Hosts who purchased overpriced homes during the boom suddenly can't cover their mortgages, so they're listing their properties. Fast. 2. Baby boomers downsizing. Millions of older homeowners are hitting retirement, selling their big homes and moving into smaller, cheaper places. This adds a massive wave of supply over the next 3 to 5 years. 3. Home builders cutting quiet deals. Builders aren't stupid. They see demand collapsing. So instead of raising prices like they did in 2021, they're now offering 20 to 30% discounts, free upgrades, temporary rate buy-downs, huge incentives, all to move inventory that's been sitting too long. And here's the key: when inventory surges, prices don't fall immediately. They fall suddenly, almost like a cliff drop, because sellers hold out, hold out, hold out. And then, all at once, the panic selling begins. And the fuel behind that panic: debt. If rising inventory is the crack in the wall, consumer debt is the wrecking ball swinging straight toward it. Because, let's be honest, most Americans today aren't just stretched thin, they're stretched past the breaking point. We're living in a moment where credit card debt is at an all-time high, auto loan delinquencies are surging, savings are at the lowest levels in 15 years, and wages, they haven't kept up with inflation for almost a decade. This isn't a normal economy. It's a pressure cooker. And if you're wondering what this has to do with the housing market, the answer is simple. When people are drowning in debt, they don't keep their homes, they sell them fast. Imagine you're a homeowner who bought in 2021 or 2022. Your mortgage is already high. Your car payment just doubled. Groceries cost more. utilities went up, your credit cards are maxed, and then something happens. Maybe a medical bill, maybe your hours get cut, maybe a layoff in your company. Suddenly, that home that once felt like an investment now feels like a liability you can't carry. And that's exactly what's happening right now. We're starting to see more homeowners missing payments, more people taking out HLOCs just to survive, more motivated sellers lowering prices quietly, more families realizing the math simply doesn't work anymore. And here's what will accelerate this even faster. The job market is weakening. Tech layoffs, retail layoffs, construction layoffs, finance layoffs. The exact industries that fuel home buying are cutting workers. This is the stage nobody wants to talk about, because once debt and layoffs collide, the crash stops being theoretical and starts becoming unavoidable, and the next domino to fall. The illusion that people won't sell because they're locked into low interest rates. That myth is about to collapse. For the last 2 years, everyone repeated the same argument. Prices can't fall because nobody will sell. People are locked into 2% and 3% mortgages. Why would they ever move? It sounded logical. It became the #1 reason analysts claimed the market was safe. But here's the truth nobody wants to admit. Life doesn't care about your interest rate. People move because they have to, not because they want to. You can't tell a divorcing couple, stay together for the sake of your 3% mortgage. You can't tell someone who lost their job, just hang in there, affordability will come back. You can't tell a family with a medical emergency, don't sell, your house rates are high. You can't tell empty nesters who can't maintain a big property, sorry, you're trapped in your low mortgage forever. Real life forces sales, and forced sales break markets. Right now, we're seeing exactly that. People relocating for jobs, elderly homeowners downsizing families, facing unexpected expenses, couples separating, investors liquidating properties that no longer cash flow. And when these people list their homes, they don't care about getting top dollar. They care about selling fast. This is why the locked-in effect is crumbling. Because yes, millions of homeowners have Lorette mortgages, but millions also have life events that make selling unavoidable. And when enough people start selling at discounts, those discounts turn into comps, and those comps turn into lower appraisals, and lower appraisals turn into falling market prices. It's a chain reaction that's already in motion, and the next big shoe to drop. Rents. The rental market is cracking too, and that accelerates the entire crash. There's one part of the housing market almost nobody watches closely, but it might be the most important domino of all, the rental market. Because when rents fall, the entire housing system starts to crack from underneath, and that's exactly what we're seeing right now. For the last decade, landlords were winning. Rents were climbing every year. Investors bragged about cash-flowing Airbnbs, and everyone thought buying rental property was a guaranteed win. But today, the rental market is quietly collapsing. Across major cities, rents are down, vacancies are up, and landlords who bought overpriced homes at the peak are suddenly bleeding money. Here's the problem. Many investors bought homes with thin margins. Some were even negative cash flow from the start, hoping rents will go up to save them. But rents didn't go up. In many areas, they're falling 5%, 10%, even 15%. And when rents drop, investors panic. Because imagine this, you bought a home for $600,000. Your mortgage, taxes, and insurance are $4,000 a month. But the market will only pay you $3,000 in rent. You're losing $1,000 a month every single month. How long can most people afford that? 3 months? 6? This is why we're now seeing more rental properties hitting the market. Investors selling at discounts, multifamily buildings increasing vacancies, landlords walking away from negative cash flow deals. Even big institutional landlords are slowing down purchases, cutting staff, and reducing acquisitions. And here's the key point. When the rental market weakens, the entire housing market loses its safety net. Because investors normally step in to catch falling prices, but this time they're stepping back. And when both regular buyers and investors pull away at the same time, prices don't just slip, they fall hard. And this problem is not just in America. The warning signs are global. Up to this point, everything we've talked about sounds like a US problem. High rates, rising inventory, falling rents, debt pressure. But here's the part most people completely miss. This is not a local issue. This is global. And global trends don't happen by accident. Across the world, housing markets are flashing the same warning signs. And historically, when multiple countries hit the same pain points at the same time, the US does not escape the fallout. Let's start with the biggest warning of all. China's real estate market didn't just slow down, it collapsed. Evergrande defaulted. Developers went bankrupt. Entire ghost cities stand empty. Property values in many regions dropped 30 to 50%. A country that built its economy on real estate has now become a case study in how fast a housing boom can evaporate. Canada, the most overpriced market in the world. Canadian homes are more unaffordable than US homes, and prices are already dropping. Mortgage renewals at higher rates are crushing families. Listings are rising. Stress is visible everywhere. Australia, falling prices and rising defaults. Australia, once famous for unstoppable home growth, is now seeing falling prices, weak demand, and loan stress. Investors are selling off because rents are softening there too. UK and Germany, prices rolling over. The UK has seen sharp price declines in multiple regions. Germany, one of the most stable property markets on earth, is experiencing falling values for the first time in decades. So what does this mean for the US? It means America isn't the exception. It's part of the same pattern. A global slowdown, rising debt, high interest rates, falling demand, overvalued properties correcting everywhere. And once global markets move in the same direction, the next phase becomes unavoidable. A real, measurable drop in US home prices. And that brings us to the big moment. How far could US home prices actually fall? And who gets hit the hardest? This is the part most people avoid, because talking about a crash is one thing. Putting real numbers on it makes it suddenly feel real. So let's do what the mainstream won't. Let's actually break down what a 20 to 30% correction looks like in real life. Right now, the median US home price sits around levels that are completely detached from income, affordability, and buying power. If the market simply returns to its historic average, not a crisis, not a collapse, just a reversion to normal, we're looking at a nationwide drop of 15 to 25%. But in overheated cities, it becomes much worse. What a 20 to 30% drop looks like in numbers: a $500,000 home drops to $350,000 to $400,000, a $700,000 home drops to $490,000 to $560,000, a $1 million home drops to $700,000 to $800,000. That's not imaginary. That's what the math demands if affordability returns to normal levels. And the markets most at risk, the places that exploded the fastest. Austin prices up absurdly fast. Now reversing Phoenix overbuilt, plus investor-heavy Las Vegas tourism-dependent. Volatile jobs, Miami massive investor speculation. Insurance crisis, Nashville supply shock. Incoming Boise pandemic bubble epicenter. LA Bay Area high debt. Low affordability, slowing tech market. These cities can easily see 25 to 35% plus declines. Because when a bubble grows the fastest, it pops the hardest. But here's the twist most people don't expect. You don't need a nationwide crash for millions of people to get wiped out. All you need is local crashes in these overvalued hotspots, and it drags the national averages down with it. So now, the big question becomes, who is positioned to lose the most? Who gets hit first? That is where things get scary. Whenever a market cracks, there are always winners and losers. But this time, the list of people at risk is much longer than most expect. Because the next phase of the housing correction won't hit everyone equally. It will hit specific groups first, and it will hit them brutally. Let's break it down. Number 1. Airbnb and short-term rental investors. These are the first to fall. They bought high, expected endless tourism, and now face lower bookings, lower nightly rates, higher maintenance, higher mortgages, lower cash flow. They can't cover their payments. They're already panic listing properties at discounts. Second, buyers from 2020 to 2023 with low down payments. Anyone who bought at the peak with 3% down, 5% down FHA loans is barely above water today. Just a 10 to 15% drop puts them into negative equity. A 20 to 30% drop wipes them out completely. Third, adjustable rate mortgage holders. These people are about to get hit with the sucker punch. As their rates reset, their monthly payments can jump $500, $1,000, sometimes more. Many will be forced to sell. Fourth, flippers and renovators. These people are in serious danger. Construction costs are still high. Buyers have vanished. Holding costs are crushing. They're stuck with homes nobody wants at the price they need. Fifth, homeowners using HELOCs as cash machines. Millions used home equity to survive the last 3 years. If prices fall, that equity disappears overnight. They're left with debt and no cushion. These are the groups that get hit first. But the crash doesn't end here. It spreads. It pulls everyone down with it. The final part of this video explains what you should do to stay safe and what signs to watch for before buying again. Let's bring everything together. The signs aren't maybe. They aren't what if. They aren't predictions. They're already happening. Inventory is rising. Affordability has collapsed. Rents are falling. Debt is exploding. Global markets are weakening. And millions of recent buyers are sitting on the edge of negative equity. This is the part where most people panic, or they put their heads in the sand and pretend everything will magically fix itself. But you're here because you want the truth, and more importantly, because you want a plan. So here's the reality. The crash isn't coming. The crash has already started. But if you act smart, you can protect yourself and even come out stronger. Here's what you should do next. 1. Stop rushing to buy. Ignore the pressure. Ignore the agents saying this is a good time. Ignore TikTok motivation. Buy when the numbers make sense, not when emotion kicks in. To build cash and keep your credit clean. When prices fall, the people with liquidity will have once-in-a-generation opportunities. 3. Watch for the 3 major signals before buying. Inventory stops, increasing days on market drop below 30 again. Price cuts decline for 2 to 3 months straight. When all 3 of these line up, that's when the market finally stabilizes. 4. Pay attention to your city. Real estate is local. A city like Miami isn't the same as Kansas City. Austin isn't the same as Pittsburgh. Comment your city below, and I'll analyze your market in the next videos. This is the moment where smart people prepare, and everyone else hopes for the best. You get to decide which one you want to be. Stay sharp, stay informed, and don't get caught holding the bag.